I understand that focus is utilizing the three main paths to wealth: paper assets, investment real estate, and owning your own business. And I guess I was going into this thinking that, well, paper assets will probably be my primary focus as far as wealth building. And then I understood that, well, a lot of people in my age, they're actually choosing the real estate route. And that's what prompted my email regarding not sure that that's going to be a viable route for me for those various reasons.
Yeah, so what I want to do is just explore it, right? So
right.
First of all, let's kind of tee up this conversation for anybody listening to us was, you had sent an email to me saying you weren't sure this is the right course for you because, you really were focused more on the paper asset side as the solution, and you were looking for, something other than just buy and hold for paper assets as the solution. Is that kind of stating it clearly?
Yes, that's right.
Okay. And so what I wanted to do is I wanted to have a conversation with you because I get this a lot, right? There's quite a few people that will join the course and they know that I've written extensively about non-traditional paper asset strategies. They were hoping to get that in this course. When they find out they don't, they're feeling like, well, it's not the right course for them. And so that may be true and it may not. And that's why I wanted to explore it, because there's different issues that come up. I mean, you can see testimonials on the course of different people, like Casey's one of them, where she thought all she wanted was a paper asset strategy. And now she realizes she didn't even know what questions to ask. And that now that she's through the course, the paper asset strategy isn't even relevant. And so I've been through this a lot with people, but I also get the question a lot. And I just, I appreciate you coming to the call and us having a recorded call to explore it so that people in the future, when they come to the course and they've got the same issue, I can refer them back to this call. Anything you want to add to that, Doug?
No, I think that sums it up pretty clearly.
Okay. All right. So behind this desire for a different paper asset strategy is something that it will give you. So what is it that you think that having this different paper asset strategy will give you? What problem will it solve for you?
Well, I guess what problem will it solve for me? I guess
in other words, you perceive it as a solution, right? So it's obvious that there's something going on where if I had this paper asset strategy, then I would have what I need, right? I mean, that's kind of the premise of the whole conversation.
Well, yeah, I guess in looking at the other options, real estate for me would be, there's a definite learning curve involved with that. And the reason I said earlier that I didn't think that would really fit into my wealth building strategy here is because at my age, I'm concerned that, we're kind of looking at the top of a real estate bubble. At least that's my intuition. And in order to go into real estate, go into debt, I'm not really too keen on the idea of riding that cycle. And
so just for posterity, so people, hold on a second, Doug, just for posterity so people know so they can contextualize the conversation, we're recording this in April of 2019.
Mm-hmm.
Okay.
Right.
And so
right.
just to throw my own 2 cents worth on it, as I teach in the course, one never has to guess if they're in a bubble or not. In terms of real estate, when you look at the way I teach the asset class, it's all about whether it cash flows or not and whether it has intrinsic value based on its income production.
Right.
And so you don't actually have to guess if you're in a bubble or not. You just have to identify valuation and see if it makes business sense or not. But anyway, keep going. I don't want to stop you. Again, part of this is just getting coaching in and getting a lot of conversation around these topics so you can explore it and decide what's true for you once we've talked about it.
Mm-hmm. Okay. I think one of the things that was for me kind of an eye-opener and that is the realization that in wealth planning, the real focus really needs to be on the cash flow rather than assets. And I guess that's one misconception I've had for many years is that I've always been focused on building up a sizable asset and then living off that for the remaining of my so-called retirement years. So
yeah,
what's kind of transformed in the last few weeks after going through the beginning of your course is the realization that I really need to be focusing on the cash flow. And
Yes.
that made a lot of really good sense. I know there's strategies with paper assets for cash flow, and I feel comfortable pursuing those type of strategies because I've had experience in various ways over the years. And so I perceive that as not being such a steep learning curve. It's building on past experience.
Okay, so let me contextualize a little bit. So, because you're jumping ahead, I'd actually having a note. One of the points I wanted to bring up was the cash flow versus asset position. Because usually underlying, so just so people listening to the conversation know, you sent me the note that drove us to record this conversation a couple of weeks ago when you first joined the course. Since then, you've been going through the course, and now you've already had this cash flow versus assets realization as a result of some of the early modules, correct?
That's correct.
Okay. And so the premise of your question was really predating that realization of, you want to be advanced paper asset. So usually there's an underlying thing here, which is most people that think they need just a better paper asset strategy are usually coming from a couple things. One, if they had a higher return on investment, that would solve the problem, right? They just need a bigger return on investment than they can expect from passive investing. The other one is that they're coming from the mountain of assets viewpoint as opposed to the cash flow viewpoint. And so you just touched on one of them is the realization of change. So let me go back to what you were saying. If it's not going to be real estate and business, then how are you going to produce cash flow from your assets?
Well, that's what I'm hoping to define going forward. I mean,
okay, because you had said you had some experience with it, so I was thinking you had something.
I've had some education, various investing courses. I know there's various strategies, for example, like selling covered calls as an income-producing strategy, and there's various others in addition to that. And I've always been shying away from the buy and hold strategy in any type of paper assets. I think using some market timing and focusing on real strong asset classes can also improve basic capital appreciation. So it's more being actively involved in the paper asset side and making decisions, and not just setting up a so-called balanced portfolio and just sitting on it for a year and then realigning it after a year or two. I think there's more active ways to shepherd that growth.
Yeah, there is actually, which I don't get into in this course, as I, plainly point out both in the sales letter and the reason for this call is that's right. Where we go with the expectancy investing course. Right. Doesn't mean you can't pursue it outside this course, but as you're already seeing, there's a lot more in this course than just investment return. Another premise that a lot of people have with this question is they think that retirement planning is just about investment return. And it's not. There's so much more to it, which we get into in the course. One of the ideas that you just touched on was the cash flow versus the mountain of assets. Another one is matching the asset class to your needs. And so one thing that we want to be really clear on right from the get-go on this conversation, I have no preference either way, right? Like I teach a concept in the course called asset agnostic. And I've walked it in my own life. I've been through all three asset classes at different cycles in my life, business entrepreneurship, paper assets, and real estate. Usually I'm doing two at any one time, almost never all three. And so I've cycled through all three in various forms over my entire career and have absolutely no preference either way. What I've learned is that they have different characteristics that match different people in different ways. And so you might be more comfortable learning the intricacies of what we'll call more advanced paper asset strategies to achieve your objectives than you are to learn the real estate one. I'm not advocating either. I'm advocating you do what works for you based on your needs, your interests. More advanced paper asset strategies tend to be really workable for the engineering mindset. I don't know, do you have an engineering mindset?
I've been working in the engineering field for most of my career.
Yeah. And again, we've never talked, right? So I had no reason to even know that, did I?
No.
Okay. So, but I can tell. Again, I've been coaching on this my whole life, right? So, I mean, I can tell pretty quick. And when people go towards advanced paper asset strategies and they're fairly comfortable, it tends to be an engineering mindset because that's the way you do it successfully. You literally have to engineer the returns. And I could tell by the way you were talking that that's how you were approaching it mentally. So that may work for you, okay? And for another person listening to this call, it may not work, okay? And what I wanted to point out is that the learning curve on paper assets is no shorter, probably actually longer than it is on real estate, but it could work better for you because that's something that you just inherently prefer and would enjoy learning about, okay? But it doesn't, when you get that, it doesn't preclude everything else in the course because all that's doing is fulfilling certain numbers that go into the retirement planning, into the wealth plan, right? So it goes into how you generate cash flow from the assets, what's the rate of return, how you manage the sequence of returns risk. All these different things are different for each asset class. And so what I teach in the course is that you have to match the characteristics of the asset class to your personal characteristics. When you get to a lesson and it's called the match game, it talks about how you match the characteristics like Velcro, right? Like you take the loops that are inherent in the characteristics of the asset class, you take the hooks that are inherent in you and who you are and what resources, skills, and interests you bring to the equation, and they have to connect so they hook like Velcro does. Does that make sense?
Yes. Yeah.
But usually, like the first question I asked you was, if you got the higher return on paper assets, what would it give you? And you didn't really answer that, right?
Well, I think like everyone else, I'm looking for the point where I think you had a key point, a name for that in one of the lessons where you are able to generate enough income that's over and above your expenses, and essentially you transpose into the financial independence or financial freedom arena at that point. Ultimately that's what I'm looking for, like everyone else.
Yeah. Now, have you gotten to the lesson where it talks about the mathematical limitations to paper assets? It's towards the tail end of Module 4.
No, I haven't got that far. I'm still
okay.
Yeah, I'm still in the identifying your why.
No worries. That's fine. The reason I asked is that's another important aspect of this conversation for anybody that, is following along and has an interest in this and believes that the paper assets is the solution. I go through and I explain in detail why paper assets is the only asset class where there's strict mathematical limits to the growth. And ultimately, that's what leads up to. That's why I know it's at the end of Module 4. I don't remember the exact lesson number. But it's ultimately what leads to the advanced planning module is those strict mathematical limits to growth. And so paper assets are actually the most limited asset class. And that's part of what I teach in Module 4 as I go through, I give a non-traditional viewpoint on the conventional approach to financial planning, which involves paper assets. And the reason I do that, I need to show what the mathematical limits are. And intuitively, anybody listening can understand this because, if you look at historically what the returns have been and you look at what the upper limit of the world's greatest investors have ever been, nobody's even breaking the 20% barrier, right? It's all in the teens. Like the really outstanding track records are in the teens. And the number of fund managers who have exceeded a 1-to-1 risk-to-reward ratio. By that, I mean if you got a 10% compounded return, you haven't had larger than a 10% drawdown. The number of managers who have exceeded a 1-to-1 risk-reward ratio, you can count on one hand with fingers left over. And usually the only reason they even did that, the few that did do it, is because they happen to be in a specific investment environment over a very limited number of time where that specific strategy that they employed worked in that exact investment environment. Like as an example, let's say you were a bond investor during the 30, 40 years of bond bull market from the late 70s to, pretty much current, right? So you had this massive tailwind at your back. You would have an unusually good bond record, or let's say you were a stock investor from the early 80s all the way to the 2000 top and then left the business, okay, which I happen to have been. right? That's how I know these track records can be very tilted. We ran a hedge fund during that period, and we were running about 17% compounded net of 3% management fee, okay? And that's because we had a tailwind at our back. If I had that over the 2 decades since, the track record wouldn't be nearly as good because I wouldn't have had a general rise in valuations over that whole time period. Okay? So we still did a lot of good stuff to earn that track record, but the point is we had a tailwind at our backs. And so I go through and I explain strict mathematical limitations of growth. That's another characteristic of that asset class and a reason why it's very limited for most people. It's not an asset class where you can make up for lost time. If you have sufficient assets, it is an asset class that if you have an engineering mindset, you can convert to cash flow, but it's not passive. It does take effort and ongoing effort, but you can do it and still be retired. You know, and you can do it in a few hours a month if you set it up right. How's that sitting with you?
No, I understand what you're saying, and you're still dealing with those mathematical limitations.
Well, you always will. There's a reason why those mathematical limitations exist, and the reason you know that I'm not full of, I'm not just feeding you lies or anything, is because you can go look at the track records of the best managers in the business. You can go look at the historical track records of the best investors known. You can take a Warren Buffett or a Peter Lynch, and you can go look. I mean, it's all public record. You can go look at the hedge funds, and those even have survivorship bias built into the track record, right? So you're only going to look at the best of the best, and they still don't exceed these numbers. I mean, there's a few exceptions, like you have, I'm not remembering, Renaissance Technologies, but that was not duplicatable by somebody like you and me. What they did was they had, a floor of employees out on the trading floors, and they all had handheld computers, and they had a whole floor of computers near the exchanges, and they were constantly crunching for inefficiencies in prices, and they had guys on the trading floors implementing them. And they were just cash flow machines. I mean, they were just raking money, implementing these things all based on computer models of correlation. And I mean, it was extremely complex mathematics, something you and I would never be able to replicate. Mm-hmm. So the exceptions are basically the exceptions that prove the rule. Right. And so there's strict mathematical limits to what you can do with paper assets. And that has to get built into your plan. You have to acknowledge that reality, and that's why we do have the advanced planning module with real estate and business entrepreneurship. And I teach different ways to go about that. But the thing about that is those involve leverage and tax advantages. And because they both have leverage advantages and tax advantages that paper assets can't provide, you'll see when you go through that module that literally you can have an unlimited return on equity. And I don't use that loosely. You can literally create money out of thin air with the business asset class. Real estate's a little different. It's harder to do that, but it's not hard to do it in business. And again, I have no preference either way, and it's whatever fits you. But what I'm trying to do is address the reality of the situation and why we teach all three asset classes, and why I wanted to get this call out there and have a discussion and get it recorded for people listening, so all these issues could surface and people could see that there's a lot more to this equation than what's typically behind the presumption entering the course, which is, I really wanted just a paper asset investing course that would solve my problems. What's going through your head now as we go through this conversation? Anything to share?
Yeah, what you just explained here, putting it in perspective with, again, mathematical limitations and the best hedge fund or best fund managers, I totally agree with what you're saying. And as you're talking, I'm beginning to see that there are significant limitations on that particular asset class. So that's making more sense to me now.
Okay.
So again, then the next asset to focus on would be the business side. And at this point, not knowing what type of business to go into or to start up, it's kind of hard to, how would you even write that into a wealth plan?
How about
that's something that takes time to evolve and evaluate potential market niches to go into. It seems like it's just not clear on how I would see that into a wealth plan. And, obviously I haven't gone through most of the course yet either. Maybe it does become more self-revealing.
It does. Actually, that's where I was going to go with the answer. I wasn't going to try to evade you, but rather point out that everybody has that question, and that's why I cover it in the course in Module 5. So I develop it in a very specific way because, again, I've been coaching clients on this for 20 years before I ever built the course. And so that's why I know the underlying issues, right? As we develop this in the conversation, it's because I've been through it a bunch. And so, as much as we want to all think we're different and unique, we're actually remarkably similar, within frameworks, right? That's how I could recognize you as an engineer, even though we've never talked. And so that is covered in the course. I'm happy to discuss it with you later on, just as anybody listening to this call, happy to discuss it later on. That's why I have the office hours for support, so you can talk with me directly on it. But I will table it until you can work through the course lessons on it. One thing I do want to add, is that okay, by the way? Is that okay that I'm tabling it? Are you comfortable with hitting the lessons first?
Yes, that'll give me a better foundation.
Okay. Yeah, and you'll see how I approach it, and it should trigger a lot of ideas for you when you see how I approach it, because it's a super low-risk way to approach it, and it is a very specific way I teach it in applying principles of mathematical expectancy and leverage and, how you apply that in a business model. And it's really, personally, I find it pretty fun stuff, and I think it's somewhat contagious, judging by how much people's wealth plans change from when they start the course to when they actually construct their wealth plan. It's remarkable to see how much it evolves for people once they start seeing all the ideas and the principles. And I see a lot of people come up with very interesting business ideas that had only been dreams before, but they were figuring out fun ways to work with it. The other thing I want to throw in on real estate, a lot of people, what they find is that converting a chunk of their paper assets to free and clear real estate solves the cash flow problem. When you listen to the sample wealth plans, you'll see a striking number of people come to that realization that real estate can serve as a cash flow producing inflation indexed bond that you never outlive and you never spend down the principal on, right? So think about that for a second.
Does that depend on the type of property?
Not really. I mean, to some extent, obviously, because, go ahead.
It's not just exclusive to rental property then?
Well, no, it would be rental property. Do you have an aversion to rental property? Is that what you're asking?
Well, no. I mean, in my case, I have a house that's been paid for, and so I have a lot of equity tied up in the house, and we're at a point where we're trying to decide, well, shall we sell it and look for something else and invest the difference? And I mean, we're at that point where this would be a good opportunity to do that, but I don't have a clear focus on what that would be.
Yeah. Well, you'll see examples of that in the sample wealth plans in the course. But I've seen several people where what they do, they apply a concept I teach called buckets of risk, and they'll get a base of cash flow that they can never outlive through real estate just to serve that base, and then they have the paper assets as like the flexible spending above that base. And then the nice thing about real estate cash flow is that it adjusts for inflation historically, right? The rents keep up with inflation. And so what they do is they get, well-located property, well-built, so it's low-headache stuff. And again, you'll see it discussed in the course, the strategy. And then they redeploy paper assets, and they find that the cash flow is much higher than their expected return, and it's higher than their safe withdrawal rate. So they can actually increase the amount of cash flow they pull from the assets beyond what their safe withdrawal rate would have been, and they're not even drawing down the assets because they're not touching the asset itself. And again, this is just another alternative strategy that you can use in a different asset class. And, that's what I go through with all the, the three different asset classes, different strategies you can apply and stuff. But it's coming back and tying through with how you bring it to your wealth plan, like how I was talking about the buckets of risk and getting the cash flow base. And then you've got the assets that you can use for flexible spending on top of that. And you can tie it in with annuities, Social Security. You'll see it's all in there.
So is that in Module 5 then? Advanced models?
Yeah, it goes. Yeah, part of it's in Module 5, and then part of it's in Module 6 when people actually assemble the wealth plans, and I show people how to assemble your wealth plan. The key, though, is you want to take it step by step. Don't jump forward, because the entire course builds brick by brick. Each section is building on the section that came before it. So, like, if you notice the structure so far, it's been that I taught you about, your personal resources and your financial resources and how to organize them and how to maximize them, right? Because your wealth is just the compound effect of your personal resources and your financial resources. Then I go into the conventional planning module, because that's the one most well known that everybody's familiar with when they come to the course with. Mm-hmm. And so I have to build the resources part first to get the foundation. Then I go into the conventional planning module in Module 4, but I give the unconventional view on it. I explain what's true about it, what's good, what isn't, what things aren't commonly understood about it. Then that sets the stage. Once you understand the limits to the conventional planning module and the limits to conventional asset allocation and the mathematical limits to those assets, then that sets the stage for why Module 5 is important. Module 5 then rounds out the education. So now by the end of Module 5, you've got the complete education. If you've followed all those lessons and you've done all the homework, literally all you do in Module 6 is assemble your wealth plan. All the pieces have been created step by going through all the lessons. So then when you get in Module 6, it shows you how to strategically put it all together to assemble your wealth plan in Module 6. Mm-hmm. Okay? So it's a very carefully structured education that builds step by step. But I really want to have this conversation with you because I've seen quite a few students short-circuit themselves because of this very issue and the premises in the issue. And I'm trying to explore a lot of the different aspects that aren't commonly understood. So anyway, is this helping at all?
Yeah, I think what I'm hearing here is the importance of putting aside assumptions and even past experience and just entering this whole education process with a very open mind, and that's one thing I'm still trying to do is put aside a lot of my early assumptions on what I thought I knew about finance and wealth, and I'm realizing that I have a tremendous amount to learn here, which is why I'm here, obviously. But
so just for people listening. So just for people listening, you're how far into the course right now?
Module 2, and connecting your number with your why. So really,
so you're just at
the why.
Yeah, so you're just in the first module of education. You're already realizing that this is very different from traditional planning, and that a lot of the assumptions you entered the course with just are already starting to go out the door. And you're just in the first educational module.
Right.
Because Module 1 is just, it's just get oriented in the course kind of stuff. So the first educational module is Module 2. Mm-hmm. Okay. I'm just wanting people to hear it that, this is a wholly different way of looking at it. You can see it in the testimonials as well. It's a completely different way of looking at wealth building that actually, it works. I built it and designed it from 20 years of working one-on-one with coaching clients. And that's why it's all structured already as a first pass on a course, because I've been through this so many times. So, and it's completely different from traditional financial planning. Traditional financial planning is covered by just a few lessons in the entire course. Mm-hmm. Yeah. So I like the way you said that about dropping the presumptions. I really like the way you said that, Doug. I hadn't thought of it that way, but that was really helpful.
Mm-hmm. Yeah. No, this is good for me because it really helps to put, like, you have the 3 classes and putting the paper assets in a different perspective than I originally had.
Which was what? What do you mean by that?
Well, last week, for example, you sent out an email, and what really surprised me, and you had this in your email, that paper assets are rarely a wealth-building vehicle. And, that puzzled me until this conversation. Yeah. So this is helpful in trying to get, the the bigger picture here, and and I guess I appreciate you taking this call now, because this will also help change my perspective as I progress through the course, and with a greater emphasis on just being really open-minded that there's probably a lot more here than I even originally considered.
Cool. Thanks. Yeah. And I appreciate you doing the call with me, because like I said, I've had a lot of people enter the course with the exact same belief structure. I mean, it's really common. And so, I appreciate you letting me record it, and hopefully it's a win for you too, just us talking.
Yeah.
But I just felt like I just wanted to get it down so that, I could just say, hey, go listen to this recording. It's already been discussed. Anything else I can add that would help you?
Maybe. I'm still a little bit unclear on the end result here after the course with the wealth plan, because, and I think it'll be, again, like I use the word self-revealing as we go through, but, and I think I'll just continue with an open mind, even though I don't clearly see what this wealth plan is. I mean, that's still kind of nebulous for me. It's still kind of hard to define it at this point of the game. So.
Well, what it does, the wealth plan is like a plan for anything else, right? In that it sets a path for you to follow to achieve the objectives. So what you do is you go through the course and engineer the wealth plan using the 3 asset classes and your personal resources and abilities, skills, interests as determined through modules 2 and 3.
Mm-hmm.
So you assess all that in modules 2 and 3. Then you work with the 3 asset classes in modules 4 and 5. Then you engineer the plan in module 6. And then in module 7, you convert it into an action plan. So essentially what it does is it tells you how to get from where you are to where you want to be financially,
mm-hmm.
right? So you set out the objectives of where the quote-unquote end destination is. And then you literally reverse engineer the plan to get there and then design the action steps. So it's an actionable plan. It's a whole design thing. But the neat thing about it, it's not, glossy paper with pie charts and all the stuff you get from a financial planner that looks so cool, but you only put it on a shelf and it collects dust and you never do anything with it. The thing about this one is because you designed it, it literally shapes your thinking and understanding, so you exit the course a different person. And because it's converted into an action plan, you actually have like dates and goals and action steps to complete, and it's an actionable thing that you work from. And then it has accountability systems built in so that if you're on track, behind schedule, or ahead of schedule. And because it's yours and it exists in something as simple as a Microsoft Word document, or if you're a Mac user, it's Pages, you go back and correct and adjust it. There's instruction on how you correct and adjust the plan in real time. So it's a living, breathing document that guides your actual efforts and your decisions. And where a lot of this came from is when I was coaching clients, they would have a million questions. Should I buy this asset? Should I do this business? Should I change this? Should I get this real estate? There's all these questions that would come up, right, around financial coaching. And what I quickly realized is that you can't do anything with a client. You can't make any of those decisions until they have their wealth plan in place. And the reason for that is the wealth plan is what organizes everything and contextualizes all decisions. And so once you have your wealth plan, literally all those questions go away because they're all decided by the wealth plan. And the neat thing about it is you're not stuck with it. Like if you have a planner do it and that's the wealth plan, that's the end of it, right? When you do it, if you have a change of plans, like you get introduced to something, you want to add your wealth plan, you know that you go in, it's a substitution effect. You can go into that document, you can go and you can change that part that you want to change, and you can see how it affects all the moving parts because you know how to do it. You designed it. You created it.
Mm-hmm.
Is that helping explain it?
Yeah, I like the fact that it is a living document and it evolves as you evolve, right?
Yeah.
Yeah, that makes a lot of sense, and thanks for explaining that.
And think about it, it's common sense, right? Like if you try to look back 20 years ago, could you have guessed where your life was going to be today and all the things that would have transpired along the way and all the changes you would have been through?
No.
No, and it's the same thing going 20 years forward, right? And that's why it has to be the way it is. That's why it's designed the way it is. is because there's no other way that it can, in fact, work.
Well, that's one of the problems with so many of these retirement calculators, and I think you may have pointed this out. No one has a crystal ball to come up with the right percentages or events or anything that to factor into these, and it just seems like such a futile effort in some ways. And I like the concept of putting it together as a wealth plan, which then provides guidance rather than a calculation.
Well, and we do the calculation too. As it turns out, the calculators are one dimension of the puzzle, if you will. Like if you imagine it's like a three-dimensional puzzle, and when you use the calculator, you're looking at one dimension. It's an important dimension, but it's also limited. And so what we do is we make the whole puzzle three-dimensional, right? So I'm not going to I use retirement calculators too, and they're in the course. You'll see it in Module 6. But we have very specific ways we use them. And there's a lot of rules around how we use them, and I'm very careful to explain what the limitations are and what they're really useful for. I mean, you think about it. If you didn't have a retirement calculator, it would be almost impossible to do all the mathematical projections. I mean, they're really good for that part of it, but as you correctly point out, garbage in equals garbage out. There's no way to correctly forecast most of the assumptions required in the calculation. And so, that's another concept I teach in the course, and why it's a living document is I teach the process of iteration. That, every few years as you live, you've got fewer and fewer years for those assumptions to have the errors compound, because you go back, you iterate your plan, and you replace years of assumptions with years of actual numbers. And so the analogy I use, it's like a rocket with a guidance system heading to a target. Is the rocket is theoretically off track for its destination 80-90% of the time during flight, but it's constantly making micro adjustments as it flies so that any small error does not compound into a huge target error, right? It's constantly correcting, adjusting back to the target, and then eventually hits the target with accuracy. As it gets closer and closer, the amount of error caused by any small targeting error is small. Well, it's the same thing with retirement planning, right? Because what is the big issue is if you have a small error in key numbers, and I teach you what the key numbers are in the course, if you have a small error in key numbers, those key numbers can compound into huge errors over long periods of time. But if you use this process of iteration of your plan in real time, then that problem goes away and is solved. And that's how you create accuracy out of things that are inherently inaccurate. There is a methodology to do it, and it's taught in the course.
Okay. No, that makes a lot of sense, Todd.
Okay.
And that's answered a lot of my questions here, so I appreciate your time here.
Good. Do you have any other questions, or is there anything else that you're uncomfortable with or anything?
No, I think this is real helpful, and it's definitely going to change the way I've been approaching the course. So this is very good.
Yeah. In the end, most people, when they come with the paper asset thing, they come with a set of assumptions. And, so that's all I want to do in this was kind of unearth the assumptions. Typically, it's the pile of assets assumption, which as opposed to the cash flow assumption. And that's a game changer once that gets cleared. And then the other one is some belief about return on investment and what's possible with return on investment through different strategies versus what reality is. And so the course, as I point out, presumes a passive index asset allocation return. And I even go through and I explain the limitations on that and kind of point out some ways in which that can get dealt with. So typically there's some assumptions, and we've addressed them in the call. So again, I really appreciate you letting me record it, and hopefully it helps other people in the future.
Okay. Yeah, very good, Todd. Appreciate it.